Hey friends, welcome to part 2 of my simple strategy. If you are new to option selling or you are not familiar with put credit spreads, be sure to watch my part 1 video that gives you a basic introduction to them. So with that, let's look at the strategy. But before I begin, as always, I'm not a financial advisor. I'm going to pop a little disclaimer up on the screen for you to read, and if you have any questions, just ask. The layered credit spread strategy is what I'm calling this one. This is a simple rules-based approach. It can be a great starter trade to dip your feet into option selling without having to learn too many option concepts at once. So if anyone has heard of the parking trade created by Tim Pearson and Dave Thomas, this is heavily inspired by that. But I'm going to give you all the information here. You don't have to be familiar with that. Anyway, it was called the parking trade because Dave's daughter used it to pay for her monthly parking. So it's a funny name, but no strategy guarantees a monthly profit. Keep that in mind. So what's a trade? SPY. SPY is a fund, an ETF, that contains all of the stocks in the S&P 500. This means it has built-in diversification, and that helps to reduce our risk. It also has very actively traded options, making it perhaps the easiest underlying stock to trade options on with the least slippage. It's okay if you don't know what all that means, just know that SPY is a fantastic options underlying. When to trade? We trade each week before the 4 p.m. close on the first down day. So the first day, the SPY is closing below the previous day's close. Leave at least enough time before 4 p.m. to put in your orders and possibly adjust the price. And if we haven't traded by Wednesday, we enter on Wednesday near the 4 p.m. close, regardless if it's an up or down day. Which expiration date to use? 45 plus DTE. So we pick the closest date that is 45 or more days out from the current day. Which options to buy and sell? Find the put option priced around $1.50, and then make the put credit spread by selling that option and then buying the strike $10 below it. Then move the two up and down, maintaining that $10 difference, to find where you collect at or just over 50 cents for the put credit spread. When we enter the trade, we will use a limit order at the mid price. This is halfway between the bid and the ask for the spread order. If we can't get filled at the mid, we slowly adjust the price until we are filled. But SPY is extremely liquid, so fills will come easily most of the time. Now you may be wondering, if we're entering every week, but we're trading options that expire in 6 weeks, won't we have multiple spreads on at the same time? And that's true by design. Layering multiple spreads weekly helps to smooth out our timing risk on entry and provides that extra form of diversification. So the trades are all still sensitive to a down move, so they all tend to move together a bit, but it's not perfect, but this will help. When to exit? We exit for 3 reasons. We exit to take a profit, we exit to take a loss before things get too out of control, or we exit if we're getting close to the expiration date on that particular spread. So for various reasons, it's better to not ride these positions all the way to actual expiration. For profit taking, if you can close, you buy back the put credit spread for 10 cents, then you exit the trade. You've made most of what's possible from the trade, and it's better not to get too greedy. So we're really looking at around a $40 profit each time on the winners. Loss cutting. If the closing trade will cost $1.50 or more, we cut our losses. This means in a normal price move against us, our risk per spread is only $100. So we collected 50 cents and then we paid out $1.50, so we paid out net $1 on the trade. That cost us $100 because of the 100x multiplier. It is possible to lose much more, or even theoretically the maximum, but normally our losing trades are going to be reasonable. Keep in mind we will have multiple spreads on most of the time, and they tend to move in sync. And the final reason being close to the expiration date. So if the spread has 7 days or less to expiration, we exit as we're getting too close to the expiration date. Also, although it would be extremely rare, if one of our short options is assigned and we now have 100 shares of SPY, we sell the shares and we sell the remaining protective put that was on that spread. These exit rules are evaluated independently on each one of our active spreads, and we do this every day near the close. Account size. So we could potentially have 6 overlapping spreads on at one time, and each spread will use close to $1,000 in margin. $10 wide spread times 100 shares, right? So trading just one pair of contracts for each position, we would need at least $6,000 in the account. I don't recommend trading all of your money in a single trading strategy, but that would be the minimum account size in your options account to trade this live. Okay, that was a lot to take in. So let's look at some examples to see this in action. These will be simulated trades on historical data, but I hope you'll find it informative, and it'll just gel everything together. So taking a look at the SPY, this is July 2023. We've been in an uptrend for some months now. This strategy does very well in uptrends, so I'd rather show this sideways choppy period starting in last November. So that's what we're going to look at. And also, although I'm going to be showing you the SPY chart as we do this together, it is not necessary to read charts at all to do this strategy. Okay, this, if you're not familiar with this is Thinkorswim. This is Ameritrade's platform. I think they're merging with Schwab right now. Other broker platforms would look different, but this is the paper trading mode, and it's in history mode. So I've set it back to November 7th, which is a Monday, at around 3:45. It's actually moved a little bit. I'm going to pretend this is a $6,000 account. I forget how to change the initial balance, so just subtract $94,000 from this as we go, right? So it's Monday. It's around 3:45. I start the clock. Time pressure's on, and I'm looking at the SPY. And today is an up day. So the rule is we don't do anything. We only enter a new trade on a down day. We've got no spreads on currently to check for exits. So I'm going to just pause this real quick, and I'm going to jump to Tuesday. So now it's Tuesday. I've come in to check. It's 3:45. It's another up day. So again, nothing to do. I don't sit here waiting to see if it's going to reverse or anything like that. It's not that critical. It's just like, oh yeah, okay, looks like an up day. We're just going to wait for Wednesday. And the rule is, of course, on Wednesday, we enter no matter what. So we know tomorrow we want to enter near the close. We actually did have a down day on Wednesday, so that's pretty handy. And it's time for us to enter our spread. I've got 15 minutes to enter my spread order, so I'm going to come over. So we're looking for 45 plus, right? So 44 is too close, so we go with the 51. Find the $1.50. So I'm going to try this one on. So that's actually I'll try this one. So 317, 307, and that's 46. So we need to get actually a little closer. 318, 308, still not close enough. As we get closer, our risk is higher, and so our credit goes up. And now we're at 51. That's great. That's what I want. I'm going to send that mid price. Here are all of my SPY positions, and what I like to do as soon as I've entered one of these, I go ahead. This is a slight cheat, right? But it's going to make your life a lot easier. I put in the order to buy it back at a limit order of 10 cents. So this is a slight deviation from what I described, in that if it can hit 10 cents in the middle of the day, even if it would have reversed, like it could get filled at any time. But it just makes life a lot easier to have this order in there. So, and it doesn't really make a difference. So here I have the buyback order, and I set it to good to cancel. That means this order will remain in the market day after day until either it executes because the price has dropped to 10 cents, or I choose to cancel it. So confirm and send over here, and I can see I have this working order for that to close. Now, there were two rules, right? We're going to close for profit if it gets to 10 cents, or we're going to close it for a loss if it gets to $1.50. Well, you see this mark price over here? That's the price for this closing order. So if this says $1.50 when we check each day, then we know we need to change this order to just exit at the $1.50, or whatever price it's at. So that's why it's kind of handy to have these sitting in the market. So that's our first spread. It's on. That's great. We'll continue to check every day, but realistically, this spread isn't going to be coming off this week. Okay, so actually, S&P popped up, gapped up, had a bit of a run. And again, you don't have to look at these charts normally. I just want to show you so you can relate what you see here to what happens on a position. But if we come over to the position, and we can see it's already gone from 50 cents, right? We sold for 50, and so we want to buy it back cheaper. And now it's priced around 19 cents or $19. So it's already in $30 of profit, pretty close to the 40 that we're targeting. And it's only been one day. Now that's a little unusual, so that's fine, but I'll take it, right? Anyway, we're going to leave this order on, and it may actually get filled tomorrow. But there's no new orders to enter because we're waiting until next week before we would enter the next spread. So with that said, let's hop over to Friday then. Okay, it's Friday, priced at 16 cents now. That's great, getting really close to that 10 cents. Normally, it's not going to, these trades aren't going to come off this fast. This is certainly unusual because we had that big gap up day, and it's continuing to go up quite heavily. So that's fine, and we will come back on Monday, and we might be looking at entering our second spread, right? Okay, so it's the following Monday, and the S&P is trading down from its close of 398.51. You can see it right up in here. right? 398.51, and today it's at 397-ish going into the close. So that means it's time to put on our second spread. Also, checking on our current spread, it's still kind of around the price that it was on Friday, right? So the market's come down closer to our risk, but time has passed, which tends to work in our favor as well. And I guess those two just kind of canceled each other out. So anyway, new spread. So we go to 45 plus days to expiration. Now, we already have a position on in December. That can get a little bit confusing. I'm going to try the 345 actually. And so $10 lower is 335, and that's 48 cents. Little too low. So let's try 346, 336, and that is 50 cents. Ship it and buy it. And I'm going to do the same thing where I immediately go to buy it back and put in an order of 10 cents, and I set that to GTC. Confirm and send, and now I can easily see what's going on with the two trades that I have on. So this one's 17 cents, still waiting. This one started out at 50, and we will check back tomorrow. All right, so the next day we're kind of up slightly. Yeah, our first trade is still sitting around that 16-cent level. The one we just put on has got a little bit of profit already, so that's great. It's not a new week, so that's all we had to do. Let's go to Wednesday. All right, so it's Wednesday, market's down a little bit. We're just kind of going sideways. The one we just put on is about the same price, and the other one also just still sitting at about the same price, so let us wait another day. All right, it's a day later, and we're kind of rolling over here, closing lower again. A little over 50 in the new one, and the price is still dropping in the first one that we put on, getting, slowly closer to that 10-cent level. So great, still nothing to do, and so we wait till the next day. All right, up a little bit, but, basically still sideways. And if we check on our two trades, they're both in profit, getting really close to our first one coming off. And we're already up $10 in the other one. And so now it's the weekend. So next week, we're going to be looking to put on our third one. All right, so it's Monday. We're slightly down from the close on Friday, which means that we get to enter our third spread. But let's take a quick look at the two that we already have on. So this one's sitting right at 10 cents. It could fail at any time. This one's in profit, so that's nice. Let's go ahead and see if 45 days, we're going to end up going out to January. 339, 329, bam. Ship it. The mark has already dropped below, so I'm going to go ahead and switch this order up. So I'm going to go, actually going to go up to 340, 330. That's a 51-cent credit. Let's send that one. Boom. Okay, that one's sold. Great. Okay, so that was this 319, 309, right? So, wait, no. That was 340, 330. Cool. We just took profit. So the 340, 330, we need to create a closing order. Okay, so I got my second trade is running. It's in profit. I just put this one on, but that's cool. So we took profit on our first one, so that one's locked in. So right now I'm in $52.50 in profit in the account. So we'll just jump to Tuesday. All right, Tuesday the market is up. We're still really sideways, but both of our trades are in profit, so that's great. But there's nothing to do. There probably won't be anything to do this week. Right, next day up a little, but basically just going sideways. Both trades are doing well. 24th is a holiday, so we're going to jump to the 25th. Okay, so that's just kind of what I would just keep doing day by day. If you get a Thinkorswim account, all right, so that's actually how I would run the trade day by day. Just a few minutes a day, really checking in, seeing what's going on. I would suggest you start out by paper trading, and you can paper trade in the platform with live data, which is good practice. But you can also use this same on-demand feature that I'm using. Thinkorswim is with TD Ameritrade. So you can use this on-demand feature, punch in a date sometime in the past, and do what I've been doing just here, where like you can go through a couple months of data in an afternoon and get experience with this and see how it works, see when it struggles. Pick a time that looks challenging, see how it was to trade it then. Let's get back to the video. So that's a simple strategy that is great for beginning option sellers. I hope you find it interesting. If you do, please leave a like as it really helps the channel. And if you have any questions, drop them in the comments and I'll try to answer them there or in a future video. Also, I used values like $10 wide or 50-cent credit based on the current SPY in July of 2023. So if SPY is trading much higher or lower than 400, you should consider adjusting those values. And in the next video, I'll talk about ways you might choose to change this strategy to suit your preferences. And I'll also share a way you can reduce your taxes. So subscribe for that, and I will see you there. Bye.